Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the Bank of Canada continues to signal optimism on inflation. Plus, high rates hurt seniors, even as it helps some of them. And healthcare in Canada is getting another failing grade. What can be done to fix a troubled system? That's all ahead. First, for the week that was in business, it's time for the briefs. The Bank of Canada held steady on interest rates again this week, another signal that Canada's central bank is feeling confident about getting inflation under control. The bank said excess demand is gone from the economy, another way of saying growth is down and the labor market is weaker. The bank isn't ringing a victory bell yet, however, since inflation could still prove stubborn, and it said it will raise rates again if necessary. Food prices are expected to rise 5 to 7% this year across all categories, according to the annual food price report. It suggested a similar increase last year, but prices actually rose 10.3% in 2022. That added $455 to the average annual family grocery bill. Canada is capping oil and gas sector emissions at 35 to 38% below 2019 levels in 7 years' time. New rules that the government of Alberta and others are already clapping back on. Separately this week, the feds upped its methane emission reduction targets for the oil and gas sector to 75% below 2012 levels. The feds have followed up on a budget promise to negotiate lower credit card fees paid by some small businesses in Canada. The reductions will only apply to those with sales below $300,000 a year for Visa and $175,000 a year for MasterCard. That means the reduction will only benefit a small fraction of Canadian businesses and, by extension, their customers. The public broadcaster said it will cut 10% of its workforce as it faces a $125 million budget shortfall. The staff reduction will come from across CBC and Radio-Canada and by keeping unfilled positions empty for a total of 800 positions lost. Meanwhile, tech firm Shopify said it will shed 20% of its staff. It's the second big round of layoffs for the e-commerce company this year. And those are your business briefs. While inflation has been moving in the right direction, we're still seeing higher than desired price increases. And of course, we're still living with the big price moves of the past 18 months. Do we need to see disinflation for life to become affordable again? Benjamin Tal is Deputy Chief Economist at CIBC. Thanks for being with us.
A pleasure. Thank you.
So I wanted to put a little context. The central bank seems confident, although they're saying they remain ready to move if necessary. Benjamin, what's your thought about the affordability problem? Because unless we see rollbacks, people are still paying more, significantly more than they were 12 or 18 months ago.
That's very true. And unfortunately, it's not going to happen. We have to remind ourselves all the time that inflation is the rate of change. It's not the level of activity. It's not the level of prices. So we all go to the supermarket. We are all overwhelmed by how expensive things are. But at the same time, we have to remember that if prices were up 8% last year and now they are up only 4%, that's disinflationary as far as the Bank of Canada is concerned. So the level is not a factor impacting their decision at this point. Unfortunately, that's the issue.
One, of course, big question we have is whether the bank has, in fact, achieved its goal. Do we get, just enough of an economic slowdown? Do we see prices continue to moderate? There is a risk that both of those things could be wrong, Benjamin, right? We could see inflation be more stubborn than the bank wants. We could see a bigger recession than the bank wants. What do you think the risks are of either of those things?
Yes, there is a tug of war between a slowing economy and inflation. And I think that in this tug of war, the slowing economy is going to win. Listen, we are basically in a recession. We are in a per capita recession. Per capita GDP is down. Per capita consumption is down. Over the past 6 months, the economy basically was flat. It will continue to be flat over the next 6 months. So we are basically in recessionary territory. The housing market is definitely in a recession. So the medicine is working maybe too well. And I think that inflation will follow suit. Inflation is a lagging indicator. It's already down from 6-7% to 3%, and it will go down to 2% over the next 6 to 12 months. I think it's almost a given the recessionary economy that we are dealing with. The U.S. situation is very different, and that's why the U.S. is doing much better than Canada, economically speaking, and the inflation there is more elevated. So one contributor to inflation in Canada is interest payments on mortgages, which of course doesn't make any sense, yes?
Right,
because the Bank of Canada is raising interest rates.
Bit of a circular problem that their mortgage payments are pricier thanks to the rate increases. Are you in the camp then that would say if we do get this recessionary period that continues for a little while, that we actually see rates coming down in a few months? I worry a little bit that people are already getting excited about the other side of all of this, and maybe that's premature.
Yes, I think that the bank is done raising interest rates, but they're not going to rush to cut interest rates. So it's not going to happen anytime soon. Our call is basically, let's say June. So we still have a significant amount of time stuck with those extremely high interest rates at 5% before the Bank of Canada will be willing to cut. They want to make sure that inflation is absolutely dead before they cut. So we believe that they will cut by 150 basis points, 1.5%, during the course of 2024, the second half of 2024, and they will continue to cut in 2025 until we reach, let's say, 2.75 or 3% overnight rate.
We've definitely seen, obviously, a cooling down in the labor market. Do you expect that to go much further? Should people be worried about their jobs?
I think that the labor market is very tight. The vacancy rate is back to normal. The unemployment rate is basically back to pre-COVID levels. I think it's going to be very challenging over the next 6 months. It's not going to be a 91 or 2008 situation. It's going to be a much milder slowdown. But I think that you will see companies slowing down a little bit in terms of spending on wages. And therefore, you will see either wages not rising, you will see attempts to increase productivity, but also, unfortunately, you will see some layoffs. It's not going to be major at this point because the labor market is very tight. And remember, companies remember the recent history of not being able to find labor until very recently. So they're not going to let them go very quickly.
Benjamin, always good to have you. Appreciate your time.
A pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist at CIBC. Still ahead, higher rates and a weaker housing market create financial trouble for many, but maybe especially for Canada's older population. Stay with us.